it's my fault. All right. So we're going to cruise back through. Again, Becks Partners. This is us. We're going to specialize on emerging markets. Again, what I said before. But really what we're going to hit on tonight, you guys, we're going to hit on warehousing and logistics. And I know that seems bizarre. Why are we talking about warehousing and logistics when you're here to see how your self-directed IRA, your 1031 exchange, or just your traditional real estate investing can be empowered? But watch and learn. Again, take notes. Again, we are A+ rated by the Better Business Bureau, and we are a solution-based company. About 75% of our clients use a self-directed IRA in one capacity or the other. It could be a solo K. That's a way to derive tax-deferred money through a 401k or an old 401k. We have a lot of clients who come in. They say, I've had this old 401k for 10 years. I kind of just parked it where it was and let it sit, and now it's time what am I thinking? Let's empower that money. And we're constantly analyzing these ancillary and tertiary markets. So what's that mean? Secondary and third markets off major metros. And tonight you're going to see this niche area of the country that's going through and is going to go through a significant, when I say significant boom, this is not a boom that's going to happen and then tail off. This is a new creation. A creation that was derived from 1914, and it's happening again today in one area of the country that we have had fantastic success. We've been tracking this since 2007. We work with Marcus and Millichap. See, what we do is we buy real estate in bulk. We either buy developments or we buy allotments from either banks or institutional investors. We'll buy, anywhere from 50 to 100 houses to 300 houses, depending on the portfolio, and we buy it all in cash, the entire inventory. So what you're able to do as an investor is really double down on the purchasing power that Beckstone has, the creation of finding the right market, doubling up with publicly traded Marcus and Millichap. They're out of California, the commercial real estate brokerage, but their multifamily house that deals with residential bulk investment is out of Washington, D.C. On our website, we do have a webinar directly with Chris Chadwick, who is the Vice President of Investments for Marcus and Millichap, and he is our broker. So we're out there looking for these tertiary and ancillary markets that you can really, really seek the benefit of it. On our website, beckstonepartners.com, you can see the real clientele. You can see them speaking about their experience, speaking about maybe the fears that they had entering investment real estate, especially in the alternative space. That is very important because, there's multiple testimonials. You're going to find yourself linking with one of those individuals. We tried to take a sample set across the country of different groups of people that have invested with us, and all different kinds of individuals. So when you go, if you want to look at the testimonials, and the full ones are on YouTube, because they are anywhere from 15 minutes to 20 minutes long, but we do have 5-minute cuts on our website. But you're going to see really and hear more specifically about why these people entered the market, why they're doing business with Becks Partners, and how it's working out for them. Because at the end of the day, there's a lot of fear that any investor has. The funny part about it that I've always seen is investors, we've been in the space over 16 years, and investors, they may have money in stocks, bonds, and mutual funds. They get a statement from Charles Schwab every month. They look at it, they log in, maybe they're making their own trades. But when it becomes real is when you actually self-direct yourself and create that avenue to invest that is alternative, but yet may seem like something you've done yourself, like buy your own home if you've never invested in real estate. And you're going to parallel the process of this with that, which is fine. But remember, at the end of the day, all you're doing is you're changing, you're shifting the way you think, you're shifting the way you you invest. So if you had $100,000 in stocks, bonds, and mutual funds, and you shift that 100,000 to owning cash flowing, income producing, appreciating real estate, you're just simply shifting that. So we got to get out of that status quo mentality of this is what I've done before, because it is exciting. And the best part about it is this is what we do every day. Whether it is self-directed or 1031 exchange, or if you're looking, we have a lot of investors who purchase inside a self-directed IRA or an old 401k, solo K. In particular, most of our clients use what I'll talk about is a checkbook controlled self-directed IRA. We work with probably the largest checkbook IRA firm, and that is their name, Checkbook IRA. We work with the Shepherd family all the time. There may be people on this webinar right now because we've recently done a few webinars with them, and maybe you missed the webinar and you just want to see it again. This is a new webinar, so kudos to you. But we're going to talk about all that, but we're going to really talk and hit on market. So what do? We don't purchase anything below B class. We don't believe in those CD neighborhoods. We don't believe in, and I see it all the time. You see a property that says, oh, 22%, 24% return, $40,000, $60,000. And the reality is, at the end of the day, what those houses are on paper aren't how they perform in real life. And the headaches that come with it, the headaches that come with the cheap house is incredible. And the cool thing about doing business with Becks Partners is you're able to take your money and make it investable 2.5 the time. What do I mean by that is every one of our properties comes with non-recourse financing in place. There is no personal guarantee. It is 100% IRS compliant. IRS says you can borrow money as a tax-deferred or qualified account. Let's just use that. As a qualified account, you can use that money as a down payment to purchase real estate. But the caveat to it is there can be no personal guarantee. So what we're used to, whether it's your own owner-occupied home or it's an investment loan that you're buying for personal use, that is a conventional loan more than likely, unless you have a relationship with a smaller bank. But 95% of the money is going conventional. What that means is it's a Fannie Mae product. It's going to be held by a Wells Fargo or Ocwen or whoever else it is out there. But at the end of the day, that money is going to Wall Street. It's a Fannie Mae product, right? So how, and there's a lot changing with Fannie Mae, as you may have read, but right now, and in the future, conventional product is never going to meet this non-recourse. They're never going to say, hey, here's a handshake interest rate of 5%, good luck. We're just going to underwrite the home. But with us, and our business model that we've been operating successfully since 2009 is we have lenders that are willing to lend that fully vet every piece of inventory that we have. When we go into purchase, after all the due diligence that we've done with Marcus and Millichap, with our underwriters here, analyzing these markets that I'm going to show you, we will underwrite, we will have an offer on the table, but it's contingent on our lender approving the individual properties for investors for non-recourse. Okay? Our properties, simply stated, are not pre-approved, excuse me. They are approved. We can close deals. If you have the funds available with a statement and a copy of your driver's license at closing, you could close in 48 hours to 72 hours. We can actually close deals with financing in place. And the interest rates, this isn't hard money. It's not even close. It's below conventional, right? There's no lenders out there that are giving you a 5% loan, non-recourse. So there's no qualifications. There's no due diligence on the borrower. We're not asking for your tax returns. It's not us, of course, but you don't go through that because the property's already been approved. The lender understands that the borrower it's going to be more than likely an LLC or an individual that is using either self-directed funds or 1031s are growing, especially here in Iowa. We're seeing a lot of farmers at this time of year. We're getting their check after the crop, and they're saying, okay, this is I'm done. I'm retiring this year. I've rented out my farm for the last 5 years. Now I have income producing real estate. Now I can shift it to a hard asset. So again, everything comes with a non-recourse loan in place, cash flowing from day one. This is the other big deal. Every property that we sell, and I'm going to show you an illustration of 3 properties here in a few. I'm going to show you the returns. I'm going to show you everything. But again, every one of them has a corporate lease as well from day one. And if you are having questions, if I am going too quick, please take notes. Now, here's one for you. If you haven't been on our webinar, heard about what we do. This is the Panama Canal expansion. This process of the expansion went actually late into 2016. It was supposed to be built by the end of 2015. But why is Becks talking about this today? Well, the Panama Canal was first built and opened in 1914, administered by Roosevelt at the beginning to make this happen. It is no secret. It is a shortcut to the eastern seaboard of the United States. The problem is the Panama Canal was highly dated. If you can imagine a ship 100 years ago to a ship that you see today, imagine that, the engineering, the infrastructure, none of that was up to date. So finally, after a lot of push and a lot of working with the Panamanian government, they approved in the early thousands, I believe it's 2005, the Panama Canal expansion to actually happen. They got the funding and were able to do it. We were tracking it and have been tracking it since 2007 on the Gulf Coast after Hurricane Katrina. Of course, Gulfport is a port town. A lot of your Chiquita bananas, if you ate one today, that came through Gulfport. And what is happening is they were out there dredging, and we said, what's going on here? What's happening? And what ultimately was happening is it's not only the box and container ships that are going up to the East Coast. The unleashing and opening up of the Panama Canal has opened up trade all across the East Coast. But there is no other port that is wide enough and deep enough for the Super and the Neo Panamax, the post-Panamax ships that are now able to go through than the Port of Virginia. The Port of Virginia, Portsmouth, Norfolk area is where this activity that we're going to talk about today all started. And we are ahead of the trend. We were 2012 to 2015, we're in and around the port. The problem is the price of real estate did exactly what we thought it was going to do. The price of real estate, the price of rents, everything skyrocketed when the Panama Canal opened because all the jobs opened up at the Port of Virginia. But what we don't think about sometimes is what is the ancillary effect of these new box and container ships that we haven't seen before ever in this area of the country? What is the trickle down, right? What is the trickle down effect of economies in and around the area, and how are businesses and how are investors like yourself benefiting from it? Here's what I'm going to do real quick. I am going to skim through news articles, third parties, trade magazines that we look at and we're analyzing when we're looking at these trends. What is it happening to American commerce? It's great. What is it happening to the eastern seaboard of the United States? Well, real quick, I'm going to just nip something. A lot of investors that we've spoken to in the last 6 months have said, well, what about tariffs? What about tariffs? We are at an area of the country that by utilizing the Panama Canal expansion, it decreases the cost to import goods. So when we think about it, as intelligent investors on this call tonight, what does that mean? that means an influx of traffic to the eastern seaboard because us as Americans aren't changing the way that we purchase goods, especially plastics, right? Technology, look at the price of a flat screen TV now when you go to Best Buy. The cost of televisions have dripped so down, but why is that happening? Is that happening because no one's buying them? Absolutely not. The reason that's happening is companies like Netflix, HBO, everybody else with the new smart TV is driving the cost down to simply a cost of a monitor because they don't want you to have to subscribe to cable networking or satellite anymore. If you have Wi-Fi at your house, you can have TV. All you need is a monitor. That's all a TV is now. So the cost has just gone down so much, which means a huge amount of inventory is coming into the United States. I mean, my son and I were at Walmart last night, and he said, "Dad, look at that, a 60-inch TV for $359." Now, don't get me wrong, it was some brand I've never heard of, but you think about a 60-inch TV 5 years ago, that's, $4,000 or $5,000, but they're bringing all this in. What else is driving that is fuel. Now, fuel is being exported. Now, when I look at this right here, imports and exports, Pennsylvania, remember this, write this down, Pennsylvania and the Panama Canal. Because tonight, everything that we're going to look at is Pennsylvania. Pennsylvania has an area that is going to explode with business. And it's starting. And right now is the time to act because we're about to see a cycle through this area of Pennsylvania that we've never seen before in an ancillary market. And I'm going to talk more about that fuel here in a second, but please, ladies and gentlemen, focus on your screen if you're listening. LTL benefits from U.S. shipping patterns shifting, right? The economy, the way that Americans import and export goods is changing again. The Port of Long Beach, and this is all sourceable, the Port of Long Beach and Port of LA, the last 2 years has lost 22% of their business year over year. The Port of Virginia is up 48%. Now, all the goods coming in, trucking, and warehousing, where do they go? If we think about the Port of Virginia and the location of it and directly west, because what we're talking about is everything being really serviced east of the Mississippi with the Panama Canal expansion. But where our properties are located are within 2 hours of New York, Baltimore, D.C., Philadelphia, all your major metros up there in the Northeast. And the cost of real estate is low. The land is there to be able to develop warehousing, and the infrastructure is there as well. And here's what I was talking about earlier. The reality of the exporting of the fuel, the hydrocarbon gas. It is incredible how much of that is going to China. And the reason that is happening is these are not available. This kind of oil, this kind of fuel, this kind of natural gas isn't available. But what is it used for? It's for that TV and all the plastics being imported back in. Look at this slide here. Pennsylvania Business Report, natural gas industry. Look at this. Wells Fargo, their report's going heavy on it. The Panama Canal expansion is driving traffic. These are all sourceable news and trade articles. This isn't the New York Times. This isn't the Wall Street Journal. These are trade magazines that is giving us the indication and showing us everything that happens. ShipBob opening Pennsylvania fulfillment center 3 times larger than the original. Do we know who ShipBob is? They are huge. The fulfillment and what is happening. I mean, look at Amazon. Look at Amazon the last 10 years. I mean, think about it. It is incredible what is happening with internet bought goods, and they all are being imported, right? They need a place to stay, they need a place to be sorted. York County, we're going to talk about here in a few. Bullseye. This isn't speculation. This is actually a broker from New York who's right around in the car that actually has left New York, is setting up shop here in York County, being a broker, bringing in all the warehousing that is happening. Ladies and gentlemen, at the end of the day, all this means is job, job, job creation. What does job creation do to real estate, especially existing real estate, right? Rents go up, property values go up. I mean, right now we're seeing a raise in our portfolio of 7% per annum on a rental rate increase on a relet. Okay. Who wants to benefit from that, and what does that do from your return? This doesn't have to be a long time hold. This doesn't have to be, it's not a 6-month hold. You got to let the market mature with what's happening here. But over the next 4 to 5 years, you guys, what is going to happen here in Southeast PA is insane. And it's one of those things that, if you don't make a move on this or act today, and you go back and you look, in a blink of an eye, which could be 3 years from now, 4 years from now, and you look back, I would hate for everybody to be coulda, woulda, shoulda investors, because this isn't us saying this is going to be a good market. This is us showing you what is happening in this area of the country. Here's another great thing. We have dark container, plastics, QVC, which is growing and growing like crazy. These are all major employers that are growing. Target warehousing is incredible, and it's only growing. We tried to send a photographer out to the property to take photographs yesterday of Target's new warehousing, and they weren't able to get where they wanted to get the photographs taken. I was going to have them on there tonight, but they're pretty well managed over there. So again, importing, exporting, this is all creating jobs. We're seeing the New York Post has an article where it talks about this area of the country being called the New Brooklyn. Imagine if you bought real estate in Brooklyn 20 years ago, even 10 years ago. What has it done? I mean, Brooklyn has quadrupled in value. Indeed.com would be the publisher or the website that, Monster and Career Builder, they're really no longer, either LinkedIn or Indeed.com. But we're sitting here in Des Moines, Iowa, downtown Des Moines. But Des Moines, Iowa's MSA, and Lancaster County, PA is the in and around area where our properties are. Now, very similar unemployment rate of 1.5%. And I would call those people professionally unemployed. But at the end of the day, look at this. The job market here is phenomenal. People here have great jobs. It's a great community. Again, it's tertiary. But on Indeed.com, if you go to Lancaster County area, you're going to see 10,000 jobs. Here in Des Moines, you're going to see about 3,400 jobs. What does that mean? If we're in line with MSA, but we're seeing 3 times the amount of jobs in a similar MSA in a market that is that close to that many major metros, how can the economy not thrive? How? Let's think about that. What are the benefits to doing business in a market that has already been set up? And here's the other thing, ladies and gentlemen. If you're buying with a self-directed IRA, it has to be 100% passive. You cannot be active with your investment. A big red flag for the IRS would be a property within driving distance of your home. We've had clients before that have said in the past that they've bought a rehab in their own backyard, and with this rehab, they've been flagged by the IRS. Who wants to be subject to an audit? Now, I'm not trying to interfere into alternative investing at all, but just be smart and let the professionals who are here at Beckstone and our brokerage house that we deal with on a daily basis, who's out there analyzing these markets for us. Again, you can watch a webinar that we've done with Marcus and Millichap. But this is who we deal with. This is these are the kind of companies that we work with. Chris right here is our broker. Chris brings us our inventory and our deals that we underwrite between him and his team. I mean, it could take up to over a year to underwrite a deal to make it make sense for you, the investor. Here's some statistics. I know they might be tough to read on your phone anymore these days. A lot of people join us on the phone, but we're looking at this would be called an inline market set to grow. In the last 6 months, we've seen a 9% growth. Does that mean you're too late? Absolutely not. But what it does mean is the time is now to double down on this opportunity, to go into it. Again, if you had $100,000 with us, you could own $250,000 in real estate. And the returns you're going to see are going to blow the stock market and the stress of the stock market, depending on who tweets what and who does what and who says what. This isn't it. We're talking about core real estate investing, supply and demand. And right now, our supply levels, right now, our portfolio is about 350 properties, right around there. And we have a waiting list for tenants. The amount of millennials moving to this area from the Northeast is out of control. It's growing like crazy. So for us to be able to put investors in a passive investment that's IRS compliant, for us to be able to indicate these markets, we could go to any market in the United States. We've been in 14 states and 41 markets within those 14 states. Right now, our core focus is where we can get our investors the highest yield today with the largest backside return. Why do you think we have a lender that's willing to lend with no personal guarantee in a market like this? Because the fundamentals are there. They understand what's economically happening. They get it. They understand that their investors are not having any personal guarantee. They understand if the investor fails, that they have no recourse to go after them for anything else outside of the property. And we've only had one investor fail, and that was an unfortunate situation that I'm not going to speak about. But that investor passed on, and it is what it is. But outside of that, it's never happened because our properties, those tenants are in place. We have corporate tenants in place from day one. Out of the gate, you sign your lease at closing. You have a 24-month lease that's going to give you a net return every month. I'm going to say that again. You're going to have a net return every month. In that first 24 months, the corporate lease, that corporate lease takes care of all the expenses on the property, if there was to be any. And that's another important thing to talk about, is when vetting a deal, we look at, if we can, rehab, you can't necessarily get a trailing record of the rental on the property, but when you have a rehab property, you know what you've done to the property to rehab it. So we have both newer construction townhomes as well as got rehab single family homes and duplexes. And another thing just to say before I show you 3 deals, understand that this part of the country, a row home or a townhome property, which would be called attached, is the norm. 70% of the houses out here are attached. It is a colonial area of the country. We had one property in Gettysburg last week that sold, a duplex. But just to kind of put yourself on the map, if you want to, this is Lancaster County, Gettysburg. It's all in kind of the same area, the Northeast. And at the end of the day, the Northeast has always been a fantastic market. It's always been a growth market. But to get into areas, in and around New York City, Boston, Philly, unless you're going super D class, it's for an investor that doesn't know the market is speculating. It's big bucks. It's low return. People are buying property right now in Manhattan on a negative 10% return, speculating. And yeah, I get it that there's only so much inventory there, but what are your risks? How much cash? How much carrying costs? That's way too risky, and I don't even want to talk about it. What I want to talk about is how you, the investor, can benefit from this. Right now, the minimum down payments are right around 56,000 plus closing costs. So you're into the just use 60,000. If you have 60,000, whether it's here's another thing. If you had $30,000 in a self-directed IRA and 30,000 outside, you can partner with yourself. You could own 50% by yourself, take that proration of cash flow, and your IRA could benefit from the other 30. Or you can do a partnership, as long as it's there's some unqualified people. You can't do it with your kids, can't do it with your parents. Up and down your tree line. If you had a sibling, someone of that nature, you could definitely do a partnership, which happens a lot. We have portfolios of clients come in all the time. So families wanting to do. We even sell to small family offices as well. But here's what you're going to get every month. You're going to get your management statement, which is going to have all the reconciliation, everything that's taken out, and that's actually going to be part of your lease as well. Here's a beautiful development that we do have some units left in. This is our Longwood development, and this is in Marietta, PA, and it is phenomenal. But if you look again at the scope, you see a lot of the attached homes there. Again, that's the norm. That's just how people live in this area of the country, what they're used to. We get people all the time saying, well, where's the big new house? And at the end of the day, the value add for owning a property like this, having your maintenance taken care of, having everything taken care of, is huge. So this is our Longwood property. I'm going to start with that, then I'm going to go into a couple gut rehabs. This property right now, we have a waiting list of 15 people. 15 people. The trailing 3 years of this property was incredible. So here's the layout. You do have an attached garage, and you do have a basement. Some of these units do have a walkout. Okay, there's no real variance in rent for walkout or not walkout. When I say walkout, that would be walkout from the basement direct into the yard, and some do not. Some people like it, some don't. To each their own, but at the end of the day, the income it produces is what's most important for us. Here's just a screenshot of the site development units that we have acquired. They're not blocked off, the ones that are sold. We've sold a large amount of these, but there definitely is some left. I'm going to run through the numbers here real quick. Now, the 3-bed, 2.5 bath, these were built in 2014. Okay, 2014 build. So we like to call it newer construction. There is not a lot of, the crazy part about it is there's not a lot of opportunity or available land in the infill of these communities to develop new construction real estate. And a lot of you may know on the call tonight, this is Dutch country. And the Amish, their farms are landlocked, right? So they're not out there selling that land. So what does that do for you as a real estate investor? Well, they're taking away supply because that supply isn't going to be developed on. So what we're dealing with is a market that is growing and is only going to continue to grow. And you have an asset that can go retail all day long. And you can always go retail on ours. And what does that mean? That means that your end buyer is going to be purchasing is their own home. And we can talk about exit strategies one-on-one, but we have other strategies we can talk about on a sale, things like lease options. where you can get a client into a lease option. Because here's the reality is we're having millennials who are coming to this area of the country, going to school in the Northeast. Affordability in the Northeast is tough to find. But you have a millennial coming out of school getting a job at QVC, right? Computer programmer getting a job for $70,000 a year. Well, in this area of the country, if you look here, the rent on this property is $1,450 a month. Well, they can afford that, but they can also afford the other things. And the lifestyle here, the lifestyle for the young millennials and young business professionals is incredible. But the one thing about it is they always come out the gate renting. Well, what can we do for them? Well, after 2 years of employment, they're going to have the track record that they can get a first-time home buyer loan. And for those of you who know, FHA has a 96.5% product, sometimes 97%. I haven't looked at a rate sheet in a bit because we don't deal with the conventional. But at the end of the day, call it 3.5% down. What a lot of people don't know is through a lease option, you cut out the broker, you cut out that 6-7% cost. And then through a lease option, you can actually give them the 3.5% closing cost credit. So when we have them as tenants, we can say, Bob, you could own this, $250,000 property with no money down. After you rent it for 2 years, you're going to have the track record, as long as you're paying on time, benefit for us, that we can get you into a locked-in return today. And with the market, this market's appreciating at 7 to 9%, but call it fair with the tenant after having them in there for a year. Call it 5% off of what you paid, and when you have inherited walk-in equity, say on this property, you sell it to them for $269,000. Well, guess what? At the end of the day, you've just inherited a buyer. You've taken your stress level down, and you put it on us, and that's what we do. Then none of that comes out of the gate, though. Out of the gate, you have a corporate lease. You're cash flowing from day one. So in this particular property, we're going to see down payment, your gross monthly rent of $1,450, your debt service, right? And how we do all this, you saw that statement before. You are not going to be cutting any checks. I'll say that again. You will not cut any checks. All the reconciliation is done by our management company there on the ground in Pennsylvania. You're going to get a statement that shows your gross rent, then it's going to show your debits, and then it will show you your monthly cash flow. Your monthly cash flow in this property of $563 a month in that corporate lease is a net number. Okay? So we get the question all the time. That number is net. Here's another thing. For all you that have signed up and joined us on the webinar, for the first 24 months, our rate for management is 4% of gross rent. There is nowhere in the nation that I know of, unless you have the volume, of 4%. Now, that's a 4% after year 3. That will go to 8%, but market in this area is anywhere from 10 to 11%. So we continue with the FAIR model. The FAIR model for us is based on volume and is based on partners like yourself, because the name Becks Partners comes from the partnership. Because our goal for you is to grow your portfolio, continuing to grow it. Take it from 2 assets to 3 assets to 4 assets to 5 assets. We look at this timetable as what can we do for our clients in the next 10 years? Because if we think about it, think about 9/11, right? Where were you when that happened? How long ago was that? Seems like a blink of an eye. Now we're talking about today. You've seen what is happening with the growth or what is coming. When they say that shift in logistics is coming, it's happening. It's not there yet. It's a process in it of its own. But if you make a decision to buy and own property, that is limited. Our inventory, when I said 350, a lot of that is investor owned, right? We've sold those to investors. We do have limited property available. We do have newer rehabs that come on board and are available to you. This one here would be one of them. This is in Hanover, PA. This is a rehab townhome. It's an attached home again. And let's look at the fundamentals of this deal. Newly renovated. It's 3-bed, 1-bath. Extra large office space. Got a little live-in area there on the patio as well, which is awesome. Purchase price on something like this is $147,900. Now, again, approved financing. Anybody on this call could own this property if they had the funds available in a checkbook by Friday. And I will tell you, the returns like this, the double-digit returns on pure cash on cash, that's rare. So if you call us, or we talk to you next week, and there's nothing at 10 or 11 or 12%, it won't be here. I can just say that, and I don't mean that to be rude. It's just the inventory when it comes on. That's what it was to say I'm going to sit and wait. The problem with that is our prices have to go in line with what's happening in the market, right? So the market, the price that it is today, the same product could be $154,000 in 3 months from now. So purchase price $147,900, loan amount that is approved at 5%, down payment $63,900, your gross rent $1,175, debt service, taxes, insurance, your 4% management fee, total monthly expenses $644. Monthly cash flow in this property with down payment $63,900, monthly cash flow at $531 a month, annual cash flow just shy of $6,400, or a cash on cash return of 10%, and your internal rate of return, which is factored on 5% of gross purchase price, is 21%, ladies and gentlemen. And someone on this call, because we do have a pretty packed house, I'm guessing by the end of the week we'll own this. Now here's a duplex opportunity for you. Again, row house here. That's beautiful, beautiful property here, smack dab in the middle. And here's the other thing, ladies and gentlemen. We have properties that could be 100 years old, could be 80, could be 60 years old. But what you get there is the quality of construction. You get properties that are built to withstand time. They just don't build them. Right now, I am, in the last 4 months, lived through a gut rehab of a house built in 1958. And it's incredible what you see. And when we have contractors coming in that are used to working on new construction homes, and they get scared because they're built so nice, and it's hard to get around, get inside those walls of those homes because they are built so well. We're talking brick plus framing, right? Look at this, Hanover appreciation. This is Q4 to Q1. So news here. This is all recent, ladies and gentlemen. Look at total appreciation rates right here. Compared to America, we're right at the top. In the last quarter, Neighborhood Scout data has seen rates that were 1.2%, or annual appreciation rate of 7%. Would you say that's fair? Would you say if I put $60,000 on a $150,000 property and I was getting 6% only on the 150, would that be a fair return? It is. It's more than fair. But did we know anything about this area of the country or this happening before we got on this call tonight? We didn't. And here's the fundamentals of the deal. Just again, this is a duplex. Okay. So you have 2 tenants in this property built in 1880. Okay. But did you see it? Would you walk down the street and say that's a beautiful, beautiful townhome? Absolutely. And again, it's a row home. It's a row home duplex. Each contains 2-bed, 2-bath. It's right down from Hanover Center Square. When I was talking about the entertainment and the activity going on, this is right down the street. So when you look at a duplex property, when you think about those millennials moving from, New York City or Washington, D.C. area, or wherever they're coming from, This is the kind of property that they're going to rent. They're going to keep as their own. Um, the exit strategy on a duplex is not as much as the lease option, unless you do have a tenant that says is smart enough to say, I'll live in one unit and rent out the other to offset. I know a lot of successful real estate investors at some point, sometime in their life have bought a duplex and lived in it and rented out the other side. And that's really where they got the itch to become real successful real estate investors. So that's just another play. We have a lot of buyers that do portfolios, 5 or 10 properties within their portfolio. And what they like to do is diversify over different asset classes. And this would be fantastic for that. This duplex is a 2-unit property. Again, $214,900, approved financing at $128,000. If you have the capital, let's call it $87,000 plus closing costs. Corporate rental at $1,770. Monthly debt service, taxes, insurance. That 4% management fee is in line with this as well. Total monthly expense is $920, but here's what we care about: $850 a month. Total annual cash flow $10,200. You guys, this is rare. 12%. 12% cash on cash return with $86,900 plus closing costs. You could own this property. It is 100% occupied, corporate tenanted, 24-month lease. So that being said, let's just really think back to this. If you have questions, testimonials, you want to watch them, go to beckspartners.com, watch the testimonials. If you have any questions about the shipping or the articles or anything like that, we can source those and share those with you. But you can see it there. It's happening. We live it. We're there, boots on the ground. Management services are right there. But you'll deal directly with your senior advisor here in the Des Moines office. And we are here right now, and I already see the phones lighting up. We're here right now to take any of your questions, to talk to you about this, to see if you want to talk further. Again, if you the minimum investment is right now 50, 55 to 60. 50 is going to be close. If you're at that 60 range, we can find you a property. A lot of people will do a house with the townhome, kind of get a blended right there. The townhomes will appreciate probably a rate of 7 to 8% because they are newer construction. Again, the gut rehabs are going to be that 6 to 7% appreciation rate. But regardless, whatever you do, however you empower yourself, it's all about making a decision and not being a coulda, woulda, shoulda investor. Just a reminder again, you can go see the real thing. That's not that's all third party interviews there. That's not Becks doing the interviews with the individuals. So you can go see that and really kind of make this real, because at the end of the day, your money is going to go somewhere, and it's going to either grow, it's going to be a headache, or it's going to be a positive. And it can be, cash flow is king. Got to have cash flow, but you also have to buy in the right market. Sure, you can buy a house in Detroit and Memphis or whatever it is that looks like it's a great cash flowing house. But what are the market indicators that are happening? What is happening that is new? When I say new, development spurs jobs. There can be existing employers in any market. There can be existing employers that grow, but they usually grow within the community once they're set in stone. But when you have new product, imagine this, and I've seen this before after Hurricane Katrina, and what development will do. Development, especially in this area of the country, brings companies, brings small business owners, brings contractors into town. Those contractors come into town. This is where the jobs are. If you're in the warehousing business, guess what? You're going to set up your family here in town because this is where you're going to thrive. And this is happening firsthand. And all the economic reports are showing it. But again, this isn't newsworthy. It's not newsworthy. So you can either email Bravo Tango BT at BecksPartners.com, info@BecksPartners.com, go to our website, or I would say pick up the phone if you're interested and you want to see more about an actual deal and what it can do for you. Give us a call right now. I'm going to wrap up for the evening. I made it in under an hour, which I'm happy about. But I really appreciate your time. If you don't have the time right now to talk, shoot us an email. We'll get you on the schedule to help you out. Because, again, at least investigate and see what it can do for yourself. We love to show people the other side. We love to see a constant return month in and month out. It is truly a set it and forget it business model for you, and you get all of the benefits from being a real estate investor and then alternative investing. One more thing I will say, you don't have to close out all your retirement accounts if you go self-directed. You can have an account where you have $100,000 in the TD account and you decide to roll $60,000 over to purchase a property through a self-directed IRA. We can do that. You keep that account open. You do what you do there. The other thing that we do offer for individuals on the webinar is we do offer coverage of your new self-directed account. We have preferred custodians that we do business with, and we can talk about that one-on-one. And we can get you that all-inclusive IRS compliant checkbook IRA. And we'll cover the cost of that as a closing cost credit. So if you do business with us and you purchase, we'll cover that cost, which could be up to a $2,000 value. If you have questions about a solo K, we can hook you up with that as well. So there's other ways to get at it. If you're a 1031 or you're a retail out of qualified funds purchaser, you know the track to go down as well. So again, thank you guys so much. I'm going to get on our way. Again, the phones are ringing. Please give us a call, 515-414-8794, or email bravotangobt@beckstonepartners.com. Thank you very much, and have a fantastic and blessed evening. Thank you. Bye-bye.